This module retains the assumptions made about the utility functions, that is, that of the Newman-Morgenstern utility function. This module is an attempt to understand the degree of risk averseness or risk seeking from the characteristics of an individual's utility function, as well as the degree of risk that different risk prospects have. These two are the determinants of the size of risk premium that the risk averse economic agents would be prepared to pay for an insurance against the risk, or the alternative, the premium that the risk seeker or the risk lover would be prepared to pay in order to gamble.
After studying this module, you shall know the determinant of the degree of risk aversion or risk seeking in terms of the utility function, learn to compare the degree of risk, learn the difference between insurance and gambling, understand the conditions under which insurance contracts can be entered into, and understand the conditions under which gambling takes place. A risk-averse economic agent is prepared to pay risk premium to avoid risk. The maximum premium in that module that an agent was prepared to pay was equal to the difference between the expected value of a risky prospect and its certainty value. This difference was determined by how risk-averse the economic agent was and the extent of the risk that characterizes the risky prospect. Next, we shall discuss the degree of risk aversion and risk seeking. The degree of risk aversion is characterized by the agent's utility function. The greater the concavity of the utility function, the greater will be the degree of risk aversion, and the greater will be the risk premium that a risk-averse agent will be prepared to pay to reduce or protect against the effects of risk for any given risky prospect, that is, a prospect with a given degree of risk. This means that the greater is the rate at which marginal utility declines with income or wealth, the greater will be the difference between the expected income or wealth of any given risky prospect and its certainty equivalent. In an analogous manner, the degree of risk-seeking activity is a function of the rate at which the marginal utility increases with income or wealth in a convex utility function. Since the utility function of an agent can have both concave as well as convex segments at different levels of income or wealth, his risk averseness or risk seeking activity will be related to the rate at which the marginal utility declines and rises over those respective segments of the utility functions. Let us learn about the degree of risk. Given the utility function of a risk-averse agent, the degree of risk is a matter of concern to the risk-averse economic agent. The degree of risk is measured by the standard deviation of outcomes about the expected value of the outcomes. This is actually applicable to a probability density function defined over the possible outcomes, which can be described by its mean, expected value, and variance. In other words, skewness and kurtosis of the probability density function should not matter. One such probability density function is a quadratic function that is symmetric about the expected value of the outcome. Another is the normal curve which is used in many economic models and which is also symmetric about the expected value. In such probability density functions defined over the possible outcomes, all that matters are the mean, expected outcome, and the variance. With such probability density functions, an economic agent can compare alternative risky prospects on the basis of these two parameters. A more general measure of risk is the mean preserving spread. If two probability density functions with the same expected value of outcome mean are compared, and it is found that the second of the two distributions assigns greater probabilities to outcomes at the tails, the second probability density function can be thought of as being a mean preserving spread of the first probability density function. What this means is that the probability of outcomes of wealth or income which are relatively considerably greater or lesser than the mean value of outcomes have a greater probability of occurring in the second probability density function than in the first. The economic agent is then more likely to experience extremes of income wealth on both sides of the average income wealth. This implies a greater degree of risk. Now let us discuss about insurance and gambling. Is there any reason to discuss insurance and gambling in the same section? In one sense, there is a similarity between the two, and yet there is a crucial difference. In both cases, the economic agent makes a payment. In the case of insurance, it is a premium, and in the case of gambling, it is for a ticket, as in a lottery or horse racing or a stake in other forms of gambling. In both cases, it involves a future event whose occurrence is probabilistic and beyond the control of the parties concerned. It is a state of nature that neither the economic agent, nor the insurance firm in the case of insurance, nor the gambling house in the case of gambling can control. If that event does not happen, the insurer or the gambling house benefit because they can keep the insurance premium or the stake as the case may be. If that event does take place, the insured gets the promised compensation and the gambler gets the winnings. This is where the two acts seem to be similar. There are, however, crucial differences. In the case of insurance, the insured is not seeking a positive gain but a compensation for loss, while the gambler is deliberately seeking positive gains. Then again, the risk that a gambler takes is speculative in nature, while the risk taken by an insured is a part of the pure risk associated with the everyday activity of carrying on a business, profession, owning property, or consuming. The risk that a gambler takes is deliberate and does not exist otherwise. The risk of the insured is as outlined above and is merely associated with acts of owning and using or operating property, assets, transporting goods, health from damages caused by accidents, fire, and other incidents. Let us now discuss insurance in detail. We know that a risk-averse agent is prepared to pay a premium as a protection to avoid or as a protection against the consequence of risk. Consider a case of a risk-averse agent seeking an insurance cover. In the discussion that follows, the absence of asymmetric information is assumed. One way of doing so is to seek insurance. Insurance premium varies with the amount of insurance cover, compensation promised, and has to be paid in advance. Take the example of a risky prospect wherein the income can be either Y with a probability of P or Y minus D with a probability of 1 minus P, where D is the amount of damage. It is assumed that P is greater than 1 minus P. In the absence of insurance, the agent's expected income EY will be EY equals to Py plus 1 minus P into Y minus D. This works out to EY equals to Y minus D into 1 minus P. For a risk-averse economic agent, the certainty value of this risky prospect YC will be the level of income whose utility is given by PUY plus 1 minus P, U of Y minus D. This is less than EY, that is, YC is less than EY. As such, the agent will be prepared to pay an insurance premium so long as he ends up with a certain income at least as great as YC. On entering into an insurance contract, the prospect will become either an outcome of Y minus FC occurring with a probability of P or Y minus Fc minus D plus C, occurring with a probability of 1 minus P, where C is the insurance compensation for the loss and Fc is the insurance premium that has to be paid. The premium is calculated as a fraction of F of the compensation amount C. The compensation amount C is at the most equal to the damage, that is, C is less than equal to D and F is less than 1. Two cases can be considered. The first case is where the compensation paid by the insurance firm equals the damage caused, that is, C is equal to D. In this case, the agent gets an income of Y minus Fc with certainty. Insurance has eliminated risk. It has also reduced the expected income from Y minus D into 1 minus P under a situation of no insurance to Y minus Fc with insurance. Under the assumption that C is equal to D, it will be the case that Fc is greater than D into 1 minus P if F is greater than 1 minus P. So, insurance eliminates risk but reduces the expected income. Will the economic agent opt for insurance? The answer is that the agent will compare the certain income with insurance to certainty equivalent of the risky prospect without insurance. If Y minus Fc is greater than Yc, the economic agent will opt for insurance. Only if Y minus Fc equals to Yc may an agent opt for insurance. If Y minus Fc is less than Yc, the economic agent will not seek insurance. What if the compensation were to be less than the damage? That is, C is less than D. This is usually the case. Then, with insurance, the economic agent would be faced by another risky prospect of obtaining y minus fc with a probability of p in a situation of no damage, or alternatively obtaining an income of y minus d minus fc plus c with a probability of 1 minus p in a situation where damage has been suffered. Compare this with the risky prospect without insurance, wherein the incomes were y with a probability of p and y minus d with a probability of 1 minus p. Let us understand this with the help of a diagram. It can be seen that with insurance, as compared to a situation of no insurance, the outcome under the favorable circumstance of no damage is lower by an amount Fc, but under the unfavorable circumstance of damage, the outcome is greater by an amount of C into 1 minus F. By taking insurance, the agent has reduced the amount of variability in the outcomes. However, the expected outcome too is lower at y minus fc minus 1 minus p into d minus c as against y minus d into 1 minus p. This again raises the question whether the economic agent will opt for insurance. He will compare the certainty equivalent of income without insurance with the certainty equivalent of insurance with insurance to come to a decision. The certainty equivalent income is one whose utility is equal to the expected value of the utility of the incomes of the risky prospect. In other words, UYC equals PUY plus 1 minus P into U of Y minus D, where UY and U of Y minus D are the utilities attached to the incomes obtained in a situation of no risk, without and with damage, respectively. Similarly, the certainty income of the prospect with insurance is one whose utility is equal to the expected value of the utility of the incomes of the risky prospect with insurance. That is, UYCI equals PUY minus FC plus 1 minus PUY minus FC minus D plus C, where UYCI is the utility of the certainty equivalent income YCI with insurance. If YCI is greater than YC, the economic agent will opt for insurance. This is but half the story. Insurance will be offered only if it is profitable for the insurance firm to remain in the industry. Besides administrative costs, it has to earn an economic return equal to its opportunity earning, which is the return of an industry of equivalent risk. In addition, it has to pay out claims as well. An insurance firm services a large number of client firms, so that the law of large numbers comes into play. Its expected costs per insurance contract are given by 1 minus P into C plus M. M is the sum of the administrative costs plus the absolute required return on the capital employed. The revenue per insurance contract is given by FC. For an insurance firm to be viable, FC is greater than or equal to 1 minus P into C plus M. This translates to f greater than or equal to 1 minus p plus m upon c. Notice that f is greater than 1 minus p, so that even if the compensation c were equal to the damage d, the insurance would not be based on a fair actuarial premium. This is because the insurance company has to meet its administrative costs plus the absolute required return on the capital employed. This also justifies the assumption made earlier of f greater than 1 minus p. Let us now move ahead and discuss gambling. In analyzing gambling, it is assumed that the risk-seeking agent has an income Y without any risk. The certainty value of this income is also Y. If this agent were to engage in a gamble, he would have to buy a ticket, which is assumed to be proportional to the price J. The cost of the ticket would be then T into J, where T is the factor of proportionality and T is less than unity. With this, the agent has actively sought a risky proposition in which he would either get an income of y minus Tj with a probability of P, or alternatively y minus Tj plus j with a probability of 1 minus p. In this example, the probability of getting the jackpot or the prize is assumed to be 1 minus p. The gamble is assumed to be not fair with t greater than 1 minus p and Tj greater than 1 minus p into j. This enables the lottery or the gambling establishment to not only pay out the prize but also meet its administrative expenses and earn the required return on its capital. Furthermore, in practice, p greater than 1 minus p. The expected value of this gamble is EYG equals to P into Y minus Tj plus 1 minus P into Y minus Tj plus J equal to Y minus J into T minus 1 minus P, where EYG is the expected value of the gamble. Since t is greater than 1 minus p, EYG is less than y. In other words, the gambler is expected to end worse off than before. This appears to be a surprising result. Then, why do gamblers undertake such activity? The answer lies, as was seen earlier, in the convex shape of their utility functions. They attach a greater weight to the gains of the prize than they do to their losses, the ticket price. Furthermore, the prize is a multiple of the ticket. Consequently, the size of the expected gain in utility outweighs the expected loss of utility. The expected utility from the gamble is given by Pu into y minus Tj plus 1 minus P into u of y minus Tj plus j. This utility corresponds to a certain income of yCg, or in other words, the certainty equivalent of the gamble is yCg. Another way of putting it is expected value of YCG equals to PU into Y minus TJ plus 1 minus P into U of Y minus Tj plus J. The economic agent will gamble if and only if YCG is greater than Y. The gambling establishment will engage with a large number of gamblers to take advantage of the law of large numbers so that its expected expenses per gamble equals J of 1 minus P plus M. It will remain in business only if the ticket it sells per gamble equals its expenses. That is, Tj equals to J into 1 minus P plus M. It will definitely be in this business if Tj is greater than J into 1 minus P plus M.
Now let us summarize what we have learnt in this module. The two determinants of the amount of premium of insurance or the ticket to gamble that an agent is prepared to pay are the degree of risk averseness or risk seeking and the degree of risk. The degree of risk averseness is determined by the rate of decline or rise of the marginal utility in the concave or convex segments of the agent's utility function respectively. In the probability density functions, which are described by their means, that is the expected values and variances, the standard deviation is an index of the degree of risk. In other functions, it is the spread of the distribution given the same size of the mean that acts as an index of risk. Insurance is a case when an agent seeks to minimize the risk associated with the probabilistic future event connected to this ownership and or the operation of the assets of the conduct of his business, while gambling is a deliberate act of seeking risk to make a gain or on a probabilistic future event. Insurance will be sought only if the certainty equivalent income with insurance is not less than the certainty income without insurance. It would be sought if the certainty equivalent of income with insurance is greater than the certainty income without insurance. Insurance contract will be entered into if the insurance premium covers administrative expenses plus return equal to the opportunity return. Similarly, a risk seeker may gamble only if the certainty equivalent of income of gamble is not less than the certainty income without gamble. He will gamble if the certainty equivalent of income of gamble exceeds the certainty income without gamble. The gambling contract will be entered into if the revenue from the sales of gambling tickets covers the administrative expenses plus the return equal to its opportunity return. To sum up finally, let us just conclude by going over the basic premise of this module. This module is about utility functions under the conditions of risk, and we are trying to explain the behavior of different economic agents or different types of behavior in the face of risk. The two factors here are the degree of risk awareness or risk seeking, as may be the case, from the characteristics of an individual's utility function, as well as the degree of risk that different risk prospects have. These are the two determinants of the size of the risk premium that a risk averse economic agent would be prepared to pay for insurance against risk, or alternatively the premium that a risk seeker or a risk lover would be prepared to pay in order to gamble.